Jordan thought he had solved the problem. He had done what a sensible person is told to do when they finally realize the giant national bank is paying almost nothing on savings. He moved his cash to a high-yield savings account. The headline rate said 4.5%. He felt smart. He felt modern. He felt like he had finally stopped being one of the people letting the bank rob them slowly. He was ahead of Maya. That part was true. He had not solved the real problem. That part is what matters. Because Maya and Jordan were both sitting inside the same machine. One was just seated farther from the exhaust pipe. Maya had about $20,000 sitting in a traditional savings account at a big bank. She thought she was being responsible. She had an emergency fund. She checked the balance. She saw a tiny interest payment every month. It did not feel like much, but it felt prudent. It felt adult. And this is how people get trained. They are not trained to ask what the bank is doing with the money. They are trained to feel grateful that the money is still there. That is a very different mentality. The FDIC's national rate data still show traditional savings paying almost nothing by serious standards. In April 2026, the national average savings rate was 0.38% on $20,000. That is only about $76 a year before tax. That is not yield. That is a tip jar. Fay turn 689,926 search 0. Fay turn 689,926 search 12. Fay. Now the average saver sees that $76 and thinks at least the money is doing something. Number, the money is doing something. It is just not doing much for the saver. It is doing much more for the bank. This is the first thing people do not understand about bank deposits. The money is not sitting politely in a vault waiting for you. It becomes part of the bank's funding base. The bank uses deposits to support lending and other asset purchases. That is the business model. You are not storing money there in the way people emotionally imagine. You are renting your money to an institution that pays you a tiny fraction of what it can earn with it. And right now, that fraction is embarrassingly small. The FDIC's own quarterly banking profile says the industry's net interest margin rose to 3.39% in the fourth quarter of 2025, the highest level since 2019. That does not mean every dollar of every deposit gets transformed into a neat 3.39% spread in a simple one for one way. But it tells you something useful. Banks as a system are still earning far more on their interest bearing assets than they pay savers on deposits. Fay turn 720,804 search. 0 Fay turn 720,804 search. 2 Fay turn 720,804 search. 6 Fay, and if you want to see where the bigger spreads live, you do not have to use your imagination. Credit card interest rates for accounts assessed interest were around 21% in the first quarter of 2026, according to the Federal Reserve. Historical rate series auto loans were in the mid-7% area. Mortgages were around the upper 6% area. Maya's bank is not paying her 0.38% because that is the best the world can do. It is paying her 0.38% because Maya is easy money. Fay turn 689,926 search 5 Fay. Now come back to Jordan. Jordan is not Maya. Jordan did the homework. He moved to a high yield account paying 4.5%. That is better. Much better on $20,000. That is about $900 in gross interest over a year instead of $76 for an ordinary saver. That improvement is not trivial. It is real. It is worth taking. This is why I do not like empty slogans. Never use a high-yield savings account again is too crude to be useful. A good high-yield account is still dramatically better than the sleepy old savings account at a giant branch bank. The first upgrade matters, but here is what Jordan still failed to ask. What is the bank doing with his money? Now the answer is the same thing. It is just sharing a little more of the pie. That is the key insight. A high-yield savings account is not an escape from the machine. It is a better seat in the machine. The bank is still the middleman. The bank can still change the rate whenever it wants. The bank is still taking the deposit, using it to fund assets or buy short-duration instruments, and handing Jordan only part of the economic value. That is why the really intelligent question is not, is a HISA better than a giant bank traditional savings account? Of course it is. The better question is, why am I paying a bank to stand between me and the same short-duration Treasury yield I could access myself? That is the question Jordan never asked, and it is the question that changes everything. Look at the actual market. The iShares 0 Fay 3-month Treasury bond ETFs Gov showed a 30-day SEC yield of 3.55% and a 12-month trailing yield of 3.94% as of the 24th of April 2026. The average yield to maturity was 3.66%. That is not fantasy. That is simply the Treasury. Bill market reflected through an ETF wrapper. Fay-site Fay-turn 689,926. Search 3 Fay Treasury Direct. The U.S. government's own platform says you can buy Treasury bills directly in maturities from 4 weeks to 52 weeks and hold them to maturity or sell them before maturity. It also says plainly that interest from Treasury marketable securities is subject to federal tax but exempt from state and local tax. That is an extremely important distinction that many savers never think about. Fay-site Fay-turn 286,863 search 0 Fay-turn 286,863 search 4 Fay-turn 286,863 search 11 Fay-turn 286,863 search 15 Fay now. I want to slow down here because this is where people get sloppy. They look at Jordan S 4.5% HISA and the trailing yield on SCOV around 3.94% and say, case closed, the HISA wins, maybe sometimes. But that depends on whether the HISA rate stays where it is, whether it is a promotional headline rate, what state you live in, what your tax bracket is, and whether you actually care about owning the underlying short duration Treasury exposure directly rather than letting a bank intermediate it. That is the part adults think about. Not only the highest gross headline, the structure beneath it. A variable rate HISA can change when the bank changes its mind. A Treasury bill bought directly gives you exactly the yield you locked at auction until maturity. SCOV gives you a tradable Treasury, bill wrapper with daily market pricing and tiny duration. A Treasury-only money market fund gives you something closer to bank, like convenience with Treasury, only exposure underneath, for example, Fidelity. S Treasury-only money market fund, FDLXX, recently showed a 7-day yield around 3.27%. That is not as high as Jordan S. Best, case HISA headline, but it is the same basic principle. Remove some of the bank spread and own the underlying government paper more directly. Fay-site Fay-turn 286,863 search 5 Fay-turn 286,863 search 9 Fay-turn 286,863 search 13 Fay. Now let us run the tax logic because this is where many people get their first real wake-up call. Jordan S. HISA interest is ordinary income. Federal tax applies. State tax usually applies too. The Treasury, bill income in SCOV or Treasury Direct, still faces federal tax but not state or local tax. That means a saver in a high-tax state may find that the after-tax gap between the flashy HISA rate and direct Treasury exposure shrinks a great deal, or disappears altogether, or even flips the other way if the bank cuts the rate. That is not a trick, that is just math. And math is what people keep avoiding until it gets expensive. Now, let me say something very clearly, because I do not want to replace one lazy habit with another. This is not an argument for moving every dollar out of checking or abandoning plain banking altogether. You still need a checking account. You still need normal transaction rails. You still need a place where rent, bills, payroll deposits, card settlements, and ordinary life move smoothly. The issue is not daily operating cash. The issue is idle cash, emergency funds, opportunity funds, cash waiting for a home purchase, cash waiting for investment deployment, cash sitting there for months or years while the bank quietly harvests the spread. That is the money I want you to think about. Because once you identify your idle cash, the menu becomes simple. You can leave it in a HISA and collect a better than average slice. You can buy Treasury bills directly in Treasury Direct and remove the middleman. You can buy SCOV or a similar short duration Treasury ETF in a brokerage account and keep the position liquid during market hours. Or you can use a Treasury only money market fund if you like the brokerage, cash experience, and daily liquidity. Those are your real options. And notice what I did not include, the old giant bank savings account paying a few tenths of 1%. That is not an option for an informed adult anymore, unless the balance is tiny enough to be operationally irrelevant. Now let us address the safety objection because this is where people cling hardest, but my savings account has FDIC insurance. Yes, and FDIC insurance is real and meaningful. It covers up to $250,000 per depositor, per insured bank, per ownership category. That is a serious protection, and I do not dismiss it. Fay-site Fay-turn 286,863 search. 2 Fay-turn 286,863 search. 6 Fay-turn 286,863 search. 10 Fay. But ask yourself what you are comparing it to When you buy a Treasury bill, you are not giving up government backing in exchange for something speculative. You are lending directly to the same U.S. federal government whose full faith and credit sits behind the Treasury market and ultimately behind the system standing behind FDIC insurance. In some ways, Treasuries are the more direct claim that matters. Now, there is a difference in operational convenience. A savings account is frictionless. Treasury Direct is not. Treasury Direct is useful, official, and direct, but not elegant. SCUV is easy to trade, but it settles like a security, not like a checking balance. A Treasury-only money market fund is convenient, but it lives inside a brokerage ecosystem, not your ordinary bank app. Those are real trade-offs, but they are trade-offs. Adults should consciously choose, not trade-offs. Adults should avoid simply because their bank trained them to believe the savings account was the natural resting place for every idle dollar. It is not. It is merely the place the bank most wants your idle dollar to sit. That is a completely different thing. Now let me answer the liquidity objection too. People say, I need immediate access. Fine, then keep an appropriate amount in checking. Keep a small shock absorber in a plain savings bucket if that helps you sleep. But be honest. Most people do not need $20,000 to settle in 60 seconds on a Tuesday afternoon, a 1 to 2 busyness. Day settlement period for part of your emergency reserve is not the apocalypse. It is a reasonable trade-off for many households, especially when the difference in yield and tax treatment compounds across years. This is why I think the real divide is not between bank people and Treasury people. The real divide is between people who understand what idle cash is doing and people who do not. Maya did not understand it. Jordan understood half of it. The investor who says, I know what the bank is doing. I know what Treasury Direct is. I know what SCUV is. I know what a Treasury only money market is. And I know why I am choosing one over the other. That person understands the whole board. That is the difference. And in money, full board understanding is usually what separates a decent decision from a durable one. Now let me tell you how I would think about the structure. I would keep my ordinary life money where it needs to be. Checking for transactions, a modest buffer for timing noise, no drama there. Then I would identify the money that is simply waiting, the emergency reserve beyond the immediate first slice, the down payment money not needed tomorrow morning, the strategic cash I want safe but not idle in the stupidest possible way, that money I would put to work in one of the Treasury. Linked channels depending on the need for liquidity, simplicity, and tax treatment. Some people will prefer Treasury Direct because they want the purest, cleanest direct claim and do not mind maturity dates. Some will prefer SCUV because they want ETF convenience in a brokerage. Some will prefer a Treasury only money market fund because it feels closest to cash management while still being tied to government paper. Fine, reasonable adults can choose differently. What I do not think is reasonable is leaving large idle balances in a traditional savings account and pretending the bank is doing you a favor because it sprinkled a few dollars of interest into your account. That was never the deal. You were simply never shown the actual menu. That is what this whole story is really about. Not that banks are evil, not that HISAs are useless. The story is that most people stop one step too early. Maya stopped at the branch savings account. Jordan stopped at the HISA. The next step is to ask what sits underneath both of them. Once you ask that, the bank begins to look less like a generous custodian and more like what it has always been. A spread business, a middleman, a profitable renter of your idle cash. And once you see that clearly, you become much harder to exploit. That is the entire point, not outrage, not ideology, clarity. If you know the machine, you can decide where you want to sit inside it, or whether you want to bypass a piece of it altogether. That is how intelligent money works. Not by chasing slogans, by understanding the spread and refusing to donate it unnecessarily. That is why I would not say, never use a high-yield savings account again. That is too stupid to be useful. What I would say is this: stop treating the high-yield savings account as the finish line. It is an improvement. It is not the end of the lesson. The end of the lesson is understanding that if your bank can use your money to earn Treasury, like returns, then you have every right to ask whether you should simply own the Treasury, like return yourself. That is the question that changes people, because once they ask it, they stop being grateful for the crumbs. And that is usually where real financial adulthood begins.